Today, we're diving into a sector of commercial real estate that is booming, self-storage. With nearly 2 billion square feet of rentable space across the U.S. and demand still growing, this asset class is proving to be both resilient and profitable, even as other parts of the real estate market face serious headwinds. I'm Kathy Fettke, and welcome to The Real Wealth Show.
You're listening to The Real Wealth Show with Kathy Fettke, the real estate investor's resource.
To help us break it all down, we're joined by Doug Ressler, Business Intelligence Manager at Yardi Matrix and a contributor to RentCafe. Doug and his team track everything from national migration trends to construction pipelines, giving them a front row seat to what's shaping the future of self-storage and real estate in general. We'll also be talking about residential real estate because the two are very much related, and I'm very excited about this interview. Before we get started, if you want to learn how to invest, and spoiler alert, you're going to see from listening to this show that it really is the time to be investing. So there's so much fear out there, and yet the fundamentals are there. We're going to talk about that in just a bit. But if you want to find out more about how to invest, where to invest, what teams to work with, you can now download a guide we made. It's free, called The Busy Person's Guide to Getting Your First Rental Property in 90 Days. Again, that's realwealth.com/90 days to get that free download. Hi, Doug. Welcome to The Real Wealth Show.
Hi, I'm glad to be with you, Kathy.
Oh, likewise. And let's just start with what you do at Yardi and what Yardi does.
Sure. We are Yardi Matrix. We're a division of Yardi Systems. Yardi Systems is a software technology company privately held in Santa Barbara, California. And Yardi Matrix is a data aggregation division for Yardi Systems, and we work with our sister divisions like RentCafe, Point to Homes, Storage Cafe that take our data on different types of commercial real estate assets and use it in media and marketing formats. That being said, Yardi Matrix handles all different types of assets, commercial real estate wise, student housing, residential, self-storage, retail, etc.
Well, let's talk about self-storage today. Despite so many economic headwinds, it seems to be doing pretty well. So why do you think that is? And is that true?
I think that, everything is not linear in this world. I think that the self-storage industry continues to face short-term set challenges, the persistent new supply, weak housing market, high interest rates, and they have made the investment market pull back a little bit. But that being said, it is still a viable investment vehicle for many. And the current trends or reasons is that it has a dynamic growth potential to it in terms of the lease rates that you're not contracted like you are with office where you contracted to a 7-year lease rate. It's much more real time, month to month, that type of thing. So revenue and income streams can vary accordingly. And at the same time, you're looking at the dependency, if you will, on local materials to be able to construct. So you don't have necessarily to worry about tariffs and those type of things to be able to do construction to keep your construction costs low. So right now it's very viable.
Yeah, for sure. And you kind of mentioned that storage is somewhat tied to how the residential market is doing, how 1 to 4 units, and the ability for people to own their home or move around. How is it correlated, storage, to the housing market?
Yeah, one of the things that we track is the relationship between migration patterns, population growth, density centers, and self-storage. So that being said, the larger populations that have a wide divergence of different social strata or demographic strata use self-storage in various and sundry ways. So if you're looking as a student that just came out of school and you want to find a smaller place and you have accumulated different items, you may look to self-storage in close proximity. If you're a boomer and you're downsizing, but you still don't want to throw away those old yearbooks, you look at self-storage and things like that. So there's different demographics that have different plausibility for the use of self-storage. In addition, what you're seeing too is in many instances, smaller home sizes, especially the new supply of homes, are getting somewhat smaller in terms of three-bedroom configurations, which means that you're going to look for various storage space to accommodate that.
Now, you mentioned demographics earlier. That is something I love to learn more about and get a little bit obsessed with. So, what are you seeing from any, kind of demographic growth, any out migration, in migration? Where are people moving? Where are they staying?
Sure. Still the South presents a tremendous opportunity. We track various migration patterns from census. Also, we look at U-Haul in terms of their annual reports. And what we're seeing is that the South has a lot of opportunity in terms of the new growth, and the Midwest that has a lot of new growth opportunities, especially in reshoring efforts and a lot of the relocation of plants that typically operated outside the United States are now operating inside the United States or going to operate inside. So what it's doing is it's creating jobs like Savannah, Georgia, Lexington, Kentucky, those type of places are seeing a surge, if you will, in terms of population density. And with that, many times initial renters, who have not decided on a place to buy if they can find a place, which is a whole nother story. They're looking for places to store their items until they become more permanent.
Well, you are speaking my language because the South and the Midwest is what we've focused on at Real Wealth for almost 20 years now, and it just doesn't seem to be slowing down. So you mentioned reshoring. What kinds of companies are reshoring to the US?
Sure, all types really. You have the electronic vehicle industry. If you buy a refrigerator today, an LG refrigerator, in all probability, it's going to come out of Lexington, Kentucky. That's where their major plant is. We also have what we call the magnifier. Toyota is committed, based off their most recent tariff deal, is not only going to build more plants in the United States, but is predominant right now in Raleigh-Durham. We have what we call a magnifier effect, where not only do you have the main thrust of a manufacturing plant, but you have the peripheral that goes around it in terms of all the support infrastructure. One of the biggest places is THMC in Phoenix, Arizona, a semiconductor plant that is going in. It is a vast city in itself. And so you see all that type of thing, and it promotes density, it promotes economic diversity, and it has what we call this magnifier effect where different things are needed, and people need storage to accommodate that.
So when, let's say Lexington, let's just use that as a city because you mentioned it and you wanted to be in the storage industry there. What do you look for? I mean, do you look for more blue collar areas, white collared, or just near job centers? What are the main factors?
Typically, what you're looking for is density profiles and zoning and permitting. One of the things that is relevant not only to the self-storage industry, but to all commercial real estate is how is the land zoned and how is the permitting in terms of time to be able to acquire said permit for whatever infrastructure you want to be able to put on it. And so what you do is you look at that and then you take that segue and you look in terms of proximity as to where people work and where they live. And so in this new age of hybrid work, a lot of times people don't necessarily live and work in two distinct places. They may live and work in the same place. So we see a lot of transit-oriented development in close proximity to where people live, where zoning and permitting accommodate self-storage.
And how do you know that there is the demand? I mean, do you just do what we do in real estate and check comps and vacancy rates of nearby storage units to see if there's demand for a new one?
Yeah, we do it there's a lot of different variables that go into the equation, but you're really looking to the point that you're pointing out. Some investors want to have freedom from institutional investments, so they want to be able to operate in niche markets that do not have a lot of competition. Other folks who are building larger, that see more population density, look at the market and what it can entail, what it can handle before it becomes saturated. So it's really a mix, if you will, of population, demographic density, per capita head count in terms of how many people use self-storage. Am I at a point of saturation or not?
Yeah, and if you get it right, at least according to Yardi Matrix's recent report, the profit margins can be pretty substantial. Like I think it was around 41% was in that article. Is that still true today?
The article was written as of March 2025, but yeah, obviously the margins are proprietary from our standpoint. We can't comment on that, but to your point, they are very. You would not see the investment that you're seeing without healthy NOI.
So, in other words, it's not too late. It's not an oversaturated market.
No, not at all, not in the least. And pick your markets well. That's what people come to us for. They want to be able to select based off of their strategic initiatives where they want to invest. And like I say, they bring different criteria, and they want to be able to look at different types of the market. They may want to look at those that are very dense urban cores like Chicago, or they may not want to look at dense urban cores. They may want to look like at Omaha, Nebraska, things like that. Or they may want to look at a specific submarket in the northwest part of Phoenix where a large semiconductor plant is going. Different criteria.
Okay, so is there something that you need to pay attention to if you are a storage investor that could turn the tides, that could make it less profitable?
Well, there's always caveats. One of the things, like I mentioned initially at the onset, is the fact of higher interest rates. And higher interest rates or a weak housing market can reduce migration patterns. They can also make the cost of construction or labor increase. So those are always areas that you want to look at. Also, you want to look at an overabundance of supply. To build a self-storage structure does not take as long as a residential asset like a 50 unit mid-size or garden style apartment, but it does take some time. And what you have to be able to do is assess, a particular area, what the demographics are, the criteria you're looking for. Does it make sense? What's the median income of this area? Am I looking at renters? Am I looking at people that own? Am I looking at a gentrified area? That type of thing. And then say, well, down the road, what are my interest rates going to look like that help me underwrite the loan that I'm going to put together to be able to build and maintain this structure? And what are my costs associated with doing that?
Well, I'm sure you can't probably predict mortgage rates because it's been pretty pretty tough or the overnight lending rate. We know that the president and the and Powell had an interesting meeting last week. And of course, the president's been really pushing for lower rates, but that all is dependent on inflation and jobs, right? So I've heard some people say they actually think rates are going to go up. And then I've heard lots of commercial real estate investors really hoping and praying and doing the dance to bring them down. Do you have any thoughts on where rates
Sure,
might go?
we track, the 10-year Treasury is really the indicator in terms of what we think is going to occur. And we actually project out through 25 and 26 what the Fed fund rate is going to be, what it is in what it has been in 23, what it was in 2024, and then what we expect to going forward. And the lower you can make that, the more you incent commercial real estate to be able to build. Right now, we see it declining. Our forecast in 2026 going into Q4 is 3.5% for Fed funds. Bond yield we think is going to be 4.5%, and the unemployment rate is going to hold steady at about 4.3%. That's through 2026. So those type of things that we forecast, people rely on us. We obviously don't do that without a lot of forethought and without a lot of introspective. And so, in so doing, we believe very, you know, strongly in the fact that we see the commercial real estate market gaining growth. Another thing that's going to allow it to grow is going to be the fact that there is a shortage of housing that's going to really come together in 26 when you see a cliff coming, because most of the surge of 500 units and up, which is unprecedented in terms of rental housing stock, which has been built last year and this year, is going to decrease to somewhere around 421,000 units in 2026. And there you're going to get into the basic economics of supply and demand. So less supply equals and a continuing growth of demand is going to accentuate the fact a need for rental properties. And we really think that rental rates are going to begin to grow in the 2027 timeframe.
Fascinating. That is something our audience is very much invested in, is residential housing, 1 to 4 units specifically. We have a lot of apartment investors as well. And with supply, with inventory levels rising, not quite where they, I don't know, some people say we're kind of back where we were pre-COVID, but there's always this fear that there's oversupply. We had this long story about being undersupplied, but the headlines basically constantly are saying the inventory is up and many markets have stalled. But you're saying that that could all turn around next year.
We think right now that let's be clear, the single family rental market it's taken us, the purchase market, it's taken us a decade of not building to get to the point where we're at. So right now, based off of, if you want to believe census or different other, it's anywhere between 3.5 to 7 million units shortfall between now and 2035. What's needed? We're not going to be able to build that many homes in a relatively short period of time to be able to accommodate that. Number one. Number two, we still believe that the interest rate is going to be somewhere around, for a mortgage, a 30-year fixed conventional, is going to be somewhere around, call it 5, 6, that type of thing, which will still require 20% down payment. And at the same time, single family builders are going to have to be able to feel they're in the business to be able to turn their property. They build it, they turn it, they sell it. And they have to be able to feel good and comfortable in terms of the fact that they have populations that will be able to afford their product. Right now, we see renters continuing to rent longer because they don't have the down payment, they don't have the affordability of housing stock that they need. And so what they do is they continue to rent longer. I think I saw recently in a John Burns webinar that the average age demographically of the first-time home buyer is 38 years old. That is significantly increased from where it was, 30 years ago. So what you're seeing is people renting longer, and the rental market has been a beneficiary of that, because that's where the demand for housing is constant, and single family housing just cannot build to the price point and a lot of times to make it affordable.
Yeah, we have a build to rent community in San Antonio, and that's one city that has had quite an increase in inventory. Yet I read the same thing with John Burns, that many build to rent communities just stopped. They couldn't make the numbers work, and they backed out, and that by 2026 there would be a great demand.
Mm-hmm. Yeah, we see the same. It is stabilized right now. And again, people that are outside the industry, they want to think in linear patterns. Everything goes from left to right and it goes up at a 45-degree angle. That doesn't occur that way. You have fluctuations.
Yes.
So with that, and that's one of the cycles that the BTR build to rent units are going through right now. But again, we think it's going to accommodate both rental market and BTR market. Rentals are really going to be accommodating the housing stock need that's out there that continues to grow.
Wow, you are a wealth of information. I think you'll be getting a lot of people interested in Yardi, although I'm sure people already are. It's a great resource for so many. So thank you so much, Doug, for being here on The Real Wealth Show. I hope you'll come back again sometime.
You bet. It's a privilege. Thanks for having me.
And thank you for joining me here on The Real Wealth Show. Again, if you want to learn how to invest, you can now download a guide we made called The Busy Person's Guide to Getting Your First Rental Property in Just 90 Days. Visit realwealth.com/90 days, and that 90 is a number. I'm Kathy Fettke. Thanks for joining me here on The Real Wealth Show, and we will see you soon.
views and opinions expressed in this podcast are provided for informational purposes only and should not be construed as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, go to realwealthshow.com.